Things are getting a little bit shaky up here, and it seems like the market is finally waking up to the reality of two hot inflation reads back to back. I wouldn't go as far, though, as confidently calling this the top, but is it possible we start to see some sort of correction? Let's take a look through the data points to answer that question based on logic. As always, check out the links listed down below in the description, hit the thumbs up button and subscribe for 100K by May, and stay tuned until the end of today's show. I've got 4 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. For the first time in a very long time, structurally, we have ourselves an inverted hammer. All this would imply is that in the upper wick of the weekly bar, the sellers really stepped up. They were able to push prices back down to the opening print and of course through the opening print for slight range expansion in the downward direction there, closing the weekly bar red. So structurally, sellers actually have the upper hand. This is the first time we've seen one of these since the October low, and even prior to that. The last one's really back here, and even at that, it's not truly an inverted hammer at the top of a range. So interesting stuff. Are the sellers building a small structural edge? Maybe a little bit here, but let's talk about location as well. On the bar-to-bar count, we still have ourselves a higher low, but we also have a lower high. So from that perspective, a little bit more neutral than outright bearish. This is a very classic inside bar setup. So on the weekly time frame chart, if we were to break down from the container bar low, it's totally reasonable to expect a little bit of a pullback here. So although structurally we have admitted that the sellers are building a small edge in that upper wick, if we think about the context of the weekly time frame chart and the trend that we're currently sitting in, we're basically sitting at the highest highs in the cycle. Of course, the weekly time frame chart can afford a higher low pullback, and of course, on the daily time frame chart, smaller time frame traders will be taking advantage of that pullback by trading shorts and looking for a weekly higher low. So what are the weekly higher low zones? Well, I'm still very interested in the top of this 2-week balance range over here. It also represents basically the NVIDIA earnings gap beginning right around 503, and we'll see that on the daily chart in just a second. And then by the nature of this being a 2-week balance range, of course, the bottom end of the range is very interesting. Basically the same thing we talked about last week at 490. If 490 breaks down, it unlocks the move into the stronger weekly line in the sand, the top of this balance range right here, closer to 480. This, as a 10-point pullback, is certainly worth trading for on the daily chart. If we get something that starts to look like this is worth trading for in the downward direction, but those are smaller time frame trades. If your time frame of execution is the weekly chart, if you're holding trades as a positional trader for months, weeks on end, then you're not probably trying to position for those short opportunity outcomes. And instead, what I would encourage you to pay attention to is more so, how can we get involved in a weekly higher low pullback anywhere above the previous all-time high? It's been this way for a long time, right? We've been talking about when a weekly pullback emerges, you can't get caught like a deer in the headlights. You have to act on that unless the weekly chart actually flips into a downtrend with lows, lower lows, highs, lower highs. Then we'll be more cautious, but we're still coming from the highest high in the trend cycle. So anything that does this offers a higher low, and we look to participate in that higher low on the weekly time frame chart as long as there's evidence of buyers stepping up somewhere over 480, right? So what else is important about 480? Let's bring out the Fibonacci's. Obviously, there's going to be no change here. We did not make a new weekly high, but your 38.2 Fibonacci retracement is right to the level, really confirming that that's a pretty key area of support, and any higher low pullbacks above it are good to go from a healthy bull flag consolidation perspective. If we take off that Fibonacci, zoom in just a little bit, I'll continue to come in from this low up to the recent high just to reinforce the idea that the 50% fib is basically the bottom of that 2-week balance range. Again, 490 roughly. If we break down from it, certainly the door is open for the 480 rotation. We've got to get there first, though. Again, let's not jump the gun. A little bit of indication that the sellers are building an edge. Again, we want to acknowledge that here on the weekly time frame chart, but we're not in a weekly downtrend yet. Let's take a look at the anchored view apps on the weekly, and you'll continue to see that this is creeping slightly higher, but still loosely aligned with that 490-ish zone. If it breaks down, again, it's making a lot of logical sense that over time, this will slowly creep up and maybe even offer confluence at the 480, reinforcing that as a line in the sand for the weekly higher low. Let's finish it up with the volume profile on the weekly. And as we zoom out here, just again, there is the high volume node. If you take a look at this, it's right at where we close. So the highest volume node that we have in these blue sky territories is the close of last week's bar. So therefore, if a deeper pullback is going to unfold, I would certainly be mindful of being red on the week, right? Next week, if we are red underneath the low of last week's bar, technically speaking, this can act as overhead supply weighing on price in the downward direction, furthering the odds, increasing the odds of a pullback unfolding. Certainly something to be mindful of. Are we pulling back from a reasonable location up here in blue sky territories? Yes, the answer is absolutely. This is the 100% extension of the cup and handle pattern. The measured move has been hit. We're pulling back from it, and as we've talked about multiple times now, the 61.8 is confluence with the top of the range here, giving us further confidence that 480 down to about 477, remember it's about a 3-point range, is certainly worth paying attention to on any stronger weekly pullbacks. We're just not there yet. Again, I would encourage you not to jump the gun. I think we can see the emerging properties of a pullback here, and if we drift into a stronger daily downtrend, we'll trade that. But again, do not jump the gun. We're still technically in a very strong uptrend on the higher time frames like the weekly. On the SPY daily time frame chart, let's begin by evaluating this week's expected move. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number's at 518 flat, basically an equal high to the all-time high, a slightly higher high over last week's high. And if we're contained by the lower bound, the number's at 501.68, implying a lower low. So for that reason, more so an equal high here. I really wouldn't argue it's a higher high, right? It's more so an equal high. Equal high, lower low, of course, that's neutral to bearish in terms of trend. So if we actually think about what the trend is here, we've certainly got lows, we had higher lows after an equal low here. These started to form as higher lows. Notice we got the equal low on the Friday session. So I wouldn't argue that we're in a downtrend yet because of the equal low. But if we look at the highs along the way, we had highs, higher highs, of course, on the Friday of 2 weeks ago. And then here, I would basically argue that those are equal highs. All three of these levels in here. So if we really think about the trend in isolation to this box, it's flipped from being bullish to more so neutral. We've got equal highs and equal lows. So when we ask the question in the intro, is it possible that the odds of a correction could increase here? Absolutely. If we were in a stronger daily uptrend, if we were pulling back from a new all-time high, higher high in the trend cycle, I would say that the odds of a correction are lower. But because we're actually in a neutral trend here, because the weekly expected move would suggest neutrality or even a bearish breakdown here, I would argue that the odds have increased for, again, some sort of correction. It doesn't mean it has to happen, but the odds have at least increased. So how might we achieve that? Well, one very explicit way of talking about a potential reversal here is a lower high, right? A lower high certainly starts to kick off a bit of a downtrend, and then as soon as we break down through these equal lows, we're in a daily downtrend, right? You have highs, lows, and some sort of lower lows. It's one possible situation. What else could technically happen? You could really bring in a lower low and then argue for the lower high somewhere in here, 509. It's another possible outcome. Let's not get too attached to these just yet. We'll get deeper into it on the hourly time frame chart, but I do want to talk about really the failure of Thursday and then Friday, right? So if we think about what happened headed into the Thursday session, right? We opened basically unchanged from the previous day's Wednesday range, right? We're basically in here, 3-bar play number 1, number 2. This could have been number 3 for a break into blue sky territories. It simply did not take place. So there were some concerns intraday, making a new lower low and trading near the lows of the Tuesday session, right? That's invalidating the 3-bar play in the upward direction. Of course, into the end of the day, got that really funky price action, closing us back inside of Wednesday's range. So if there were ever a time for the buyers to say, oh my goodness, whew, thanks for giving us the gift right back, now we're going to look for upside continuation, that was a close call, that was the time for that to happen. Let's think about why, right? Because from here to here, in this lower wick of the Thursday session, right off of 512, basically to the penny, that was going to offer a higher low. All it would have required is a break through the equal highs, and the trend remains firmly in the upward direction, right? That obviously did not take place. And on Friday morning, we open on a gap down. Look at the upper wick of that bar, gap fill reversal, closes more indecisive down towards the lows of this as a newfound balance range. So again, as we sort of consider who has the upper hand here, the buyers had a little bit of a gift into Thursday's close. Friday's open takes that gift right back and neutralizes the market for all of the reasons that we've just discussed. So right now, on the daily time frame chart, I would tend to keep a more open mind for this neutral balance range resolving either in the downward direction, which we'll build some evidence for as we walk through today's episode, or if we stay stuck inside of the range, it's certainly possible that this starts to feel a little bit more like a distribution zone, and over time we'll keep a very close eye on what happens with the 509 level. With that said, let's get even more granular on the hourly. So the trend here is certainly down with highs, and lower highs on Friday. Here are lows, lower lows on Thursday, lower lows on Friday. Trend is down, and continued lower high consolidation can happen underneath 512, and very classically this would build out as bear flag consolidation. As a matter of fact, if we bring out a Fibonacci from the highs here to the lows of the Friday session, there's your 38.2, perfect confluence with 512. So all good. We understand that the bears remain in control if the consolidation is here. Of course, that means that the threat is now underneath 509, which we've just identified on the daily time frame chart as a bunch of equal lows. If we break down through that, we get some sort of lower low, and we start looking for downside targets. Notice that as we start to break down volatility, and we'll see this in the VIX as well in just a moment, volatility is increasing. So I wouldn't put a lot of emphasis on the 507 level as I would the 505.25. It really represents the bottom of this prior range over here. That would be the major target that we're looking for. So if the bear flag is going to continue to consolidate, we know that we are looking for continued activity here or a breakdown underneath 509. If the market just continues in the downward direction under 509, the name of the game is looking for lower highs underneath 509. And over time, yes, on the daily time frame chart, as we've already identified, the NVIDIA earnings gap is the possible target in the downward direction. 503 is the top of the gap, and the gap closes down at 497. One step at a time. We're not all the way there yet. We're still technically speaking in a neutral trend in this box, right? So although I would argue that there's a change in tone here, let's talk about this, right? If we look at Monday's gap down underneath a bearish engulfer from Friday, how did we close that day's session? We actually closed near the highs, and then on Tuesday we get a gap fill reversal in the upward direction, closing Tuesday's bar at the high of the session. If we look at Friday, it's a gap down, and instead of closing near the highs of that session's range or battling for price acceptance inside of the Thursday range, we actually closed weak underneath the opening print. So there's a change in tone here. The tables have turned, where in the past I would argue that the buyers continued to step up every single dip got bought, right? Whereas on Friday, we're starting to see the first signs that buyers are either skeptical or the sellers are starting to come out of the woodwork. So I think an appropriate way to phrase this is that the market seems more susceptible now at the end of the week for a possible correction than it did at the beginning of the week. At the beginning of the week, we certainly saw the opportunity for a higher low, and we basically traded back up into the equal highs. Now that we're in this as a neutral range and trading near the bottom portion of that range, threatening the 509 bottom, I would argue once again that the appropriate terminology would be the market is more susceptible for a correction here compared to the beginning. Doesn't mean it has to break down. It doesn't mean that we would just want to automatically assume, oh my goodness, bears are taking control, markets are going to zero. It's not what we're saying, but we are saying it wouldn't be unreasonable for continued consolidation here to look bearish, breakdowns of 509 with a lower high to be bearish, or even if we were to break up and over 512, I would be much more skeptical about the long here for a potential hourly higher low. That's great, but the daily lower high threat up against 515.25 is real, as we've just discussed on the daily time frame chart, right? We could do something like this, trade back down to the equal lows, and now all of a sudden we have ourselves that very classic Man Ray pattern looking something like this, right? Highs, lower highs, break down through the neckline, the equal lows, and we look for a move in the downward direction. So it begs the question, Matt, what the heck has changed, man? You've been so bullish coming into this move. Obviously, we've talked about the neutral trend. Where would you side back once again with the buyers in this market? It's a good question. I would say that in here, I mean, just look at the evidence from the Thursday afternoon session. Do you want to get involved in that as a clean area to be trading in? I would certainly argue no. It was just a lot of round tripping, up, down, up, down, up, down. And, you know, I like, to be honest with you, I would not be surprised if there's an arbitrary lower high set somewhere inside of this range. The lower high does not have to be on the daily chart perfectly up against 515.25. So again, going back to the question, where would we side back with the buyers under the current market circumstances? It's really twofold, right? First one would just be, yeah, we get some sort of activity in here, and then price acceptance over 515.25, where that Thursday afternoon sort of volatile consolidation was taking place. If the market hangs out up here, great. We'll look for a move into blue sky territories. As of right now, there's a lot of work to be done for that to be a reasonable outcome, right? That's number one. Number two is that this turns into a huge look below and fail. If we get something that looks like this, if this turns into an hourly inverted head and shoulders, something bullish that would suggest, okay, the sellers had their chance. It looked like we were coming in off of this very nuanced lower high, equal high. We were finally in a neutral daily trend. We were not in a daily uptrend. If the sellers fail this opportunity, and there's a higher low right here, you better bet your bottom dollar all day long I'm going long, stop, target, target, target. Right? That's the name of the game on a look below and fail. Classically, the target is technically the top end of the range every single time for the full range rotation, but understanding the volatile context of the market as we're sort of navigating these hot inflation prints, I would be trimming here, I would be trimming here, and again, we're sort of navigating from a point A down here towards a point B with potentially multiple pit stops along the way. So that's really the way I'm seeing this market currently. If we take out the intraday anchored view apps, let's just take a look and see what these would suggest. Again, I think that this sides with our sort of mantra so far, which is that the market seems more susceptible for a correction. Notice that we're underneath the all-time high anchored view app. That's this one here. The Thursday anchored view app right here is there at 512, offering potential again for confluence and continued bearish consolidation in this zone. And then we're also underneath the pre-NVIDIA earnings gap and post-NVIDIA earnings gap anchored view apps as well. So right now, I think that the bears have their opportunity in front of them. They just need to get that breakdown follow through underneath 509, lower highs here, or continue to reject, consolidate in here, and then break down over time. If this fails, we will certainly be willing to change our tone from neutral, maybe back to slightly more bullish, but as of right now, that's what I'm seeing. Let's take a look now at some supporting evidence. Market internals are always supporting evidence exhibit A. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. I think that the screen really speaks for itself, right? We're neutral with a slight bearish edge headed into the coming week's worth of trade. If you look at the Thursday session, strong volume outflows. If you look at the advanced decline line underneath and in trend lower zone, if you look at the cumulative build, it really speaks for itself. It was a consistent 45-degree line all day. It's not like we saw some sort of liquidation break and then really neutralized for the end of the day. No, it was consistent building throughout the duration at the exchange level. So if we follow that up with Friday's session, right, it really wasn't like we got a ton of follow through. You can see a little bit more neutral on the Friday session in here, but that's exactly what we've sort of set forth as a reasonable expectation for this week. Neutral with a bearish edge as we're hanging out near the lows of that balance range on the hourly. Market profile is always exhibit B. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Because of the futures contract role, we're going to just sort of loosely focus on value areas, point of control, and individual structure, not necessarily larger levels. If we think about Thursday's session, this to me was the nail in the coffin for the move. And the reason I'll say that is because you can clearly see the A period single prints rejecting this as overhead supply as well as this as overhead supply from the Tuesday and Wednesday sort of consolidation here. And the fact that value built out lower, the fact that the point of control migrated in the downward direction gave me some hesitations here to sort of say, okay, if the buyers were truly going to exhibit strength on this open up here, there's the A period opening print, right? Then we should have gotten some sort of attempt at least. It didn't have to be pure consolidation and acceptance inside of the range, but there should have been some attempt at minimum to hold support in here. You maybe would have gotten some sort of reaction to it, consolidation, then an end of day breakdown. You could have broken down, retested it. You'll notice that there's not even a retest in there of the value area low from the Wednesday session. So do we have overhead supply that's trapped? Absolutely, based on this indication from the Wednesday and Thursday interaction. And then you can see on the Friday session, the value area is clearly lower, which shouldn't be a surprise because we know that it was a gap down and we held that gap down. But notice that we do have a poor low. So if that needs repair, that would imply that sweeping the lows might be reasonable. And then we'll look for a reaction. Do we battle back up into the Friday range or do we accelerate in the downward direction for the larger daily breakdown we've just described on the SPY candle charts? The last poor structure that I want to leave you with is what happened here on that Wednesday session high. This is still a poor high. It has not been resolved. We did not trade through it on the Thursday morning session. Doesn't mean that we have to go there this week, next week, or the week after, but do understand that the auction has ended improperly at the top of this move. And generally speaking, as a back pocket idea, the all-time high in a market is not going to be set in the manner that which we have one right now. You want to see the market put in an excess high, an exorbitant, euphoric, excited all-time high. That is how you know the auction is ending properly, and then you can back off away from it. As of right now, we do not have that, but once again, I want to be very clear, very, very clear that that is not a call to say we are going to make a new all-time high this week, next week, or the week after. We just understand that this structure has the improper end. It's sort of deficient structurally, and if tested, right, if we were to trade back up towards the top of the balance range, on any first tests, I would be looking for the market to break through that. That's the main takeaway with identifying poor structure. Changing gears to the QQQ on the weekly time frame chart, what do we see here in terms of candle structure and location? Just like the S&P, we finally got ourselves a bearish inverted hammer with a little bit more body size on it compared to the S&P, just meaning that yes, the seller stepped up at the upper wick, pushed to the opening print, but more substantially saw range expansion in the downward direction and closed a little bit weaker than what we saw in the S&P. So structurally, sellers have the upper hand. If we think about location on the bar-to-bar count, certainly a lower high as well as a lower low, whereas the S&P produced an inside bar, right? So definitely more of a bearish edge here if we think about structure and location going hand in hand. And we can even go one step further with location, right? Because we know that these lower wicks, specifically the lower wick of last week's bar, or 2 weeks ago, I should now say, actually found support off of the prior top of the balance range here, whereas this week we've closed inside of the previous balance range. So that to me is a sign of weakness, right? You have a breakout, an attempt for a higher low above that has failed, and now we've closed inside of that range that is not making progress in the upward direction. So as we walk forward, what's the idea? If we break down underneath this zone, we are looking for the stronger pullback into this zone. As we know, this is 410, 412, and this up here is that 425 as discussed in last week's episode. If we bring out the Fibonacci's from the low of the October move to the top, you'll notice that this 38.2 is loose confluence with the 408, 410, 412. Treat it as a little bit of a zone. It's the top of this as a balance range. So on the weekly time frame chart, although there is more weakness here, it's a lot of weeks, there's more weakness, we are looking for follow through to the downside, there's still an opportunity for a larger higher low to keep the trend in the grand scheme of things intact and in the upward direction. If we bring out the Fibonacci's from the bottom to the top of this as a move, we're still technically over your 38.2 here. So if we find support over loosely that 425, 428 zone, that would also make sense as a continuation move of this as an isolated segment of the larger trend that we were just evaluating. Let's bring out the anchored view apps on the QQQ. Just as a reminder, this is loosely your 425 zone, so supporting that idea. If we break down underneath, the larger target becomes the 412 as we've just discussed. So if the weekly is really going to deteriorate, right, a lower low here, a lower high, then this is a possible outcome when and if we get here. Certainly thinking about the opportunity for the higher time frame analysis of trend from here to here to produce the higher low and remain in an overall uptrend, right? So thinking about the trend in different fractals, if you will. You've got the entire move from here to here, and then you've got the minor move from here to here. So thinking about those two outcomes. Let's move along to the volume profile on the QQQ. And as a reminder, your all-time high is not quite as cleanly confluenced with the top of the range. It's more aligned with, I would argue, the Fibonacci, right? 408 as a possible level, right? And if we take out this high volume node, right, which we've closed underneath. So really the more appropriate term would be if we extrapolate that high volume node, you can see we're underneath. So just like the S&P, I would argue that this can more easily turn into overhead supply. We're probably even a little bit further underneath the high volume node compared to what we had on a relative basis in the S&P 500. So overall, certainly seems as though the NASDAQ, and we've known this for a while, right, is the index with a little bit more relative weakness. If we bring out the Fibonacci's for the cup and handle, just want to check in on where the 61.8 is. That is confluence with your 425. Remember that this is a little bit more of a pie in the sky style target as of right now. So not thinking about that 475, but instead focusing on the 61.8 being here at the 425. So I think the levels are very straightforward. I still think we're in a strong overall uptrend here on the QQQ, obviously. If we do pull back, it's totally reasonable that a breakdown here gets us to the 408, 410, 412 zone, but still thinking about what's the opportunity for a higher time frame, higher low. On the QQQ daily time frame chart, here's the weekly expected move. If contained by the upper bound, the number is at 443.88. Sure, it's implying an equal high to the high of last week, but it's still a lower high from the all-time high and the recent high in the trend cycle. If we take a look at the lower bound of the expected move, the number is at 424.03, implying a big-time lower low, but more importantly than that, it's implying that not only can we close the NVIDIA earnings gap, but we can even extend a little bit beyond it towards the bottom of this prior structure back from over here, closer to that 423.50. If we're thinking about trend on the daily time frame chart, we could just come right out and say it. This is totally a neutral consolidation range with a small bearish edge, noting the fact that we've already pointed out we have a high, a lower high, and if we take a look at the structure of the Friday session, right, in that upper wick, there's clearly no attempt from the buyers to get price acceptance inside of the Thursday range, but also if we extrapolate out this key level at 438.50, remember prior rejections, rejections, really struggled with that level to start to produce a higher low above. Some early indications, although sloppy on Tuesday, Wednesday a little bit, Thursday not so much sloppy again. Friday is just a straight up rejection of that 438.50, a very weak close on the lows of the move, and once again threatening an equal low breakdown. You could even make the argument, like if you wanted to split hairs with me, you could say we've got lows, technically speaking lower lows, at the bottom of the Friday session range, and therefore from here to here, that starts to confirm a daily downtrend. Again, I would probably side a little bit more so with the neutral outlook so far until we are firmly closing inside of that NVIDIA earnings gap under 433.75, but as of right now, it's very clear that we're neutral with a bearish edge, sort of anticipating this breakdown. So how do we get involved? Of course, breaks, lower highs within the range, maybe a small reaction here at 430 based on previous structure. 50 SMA might meet you there on the daily time frame chart, but I would not second mortgage the house on that level. I would really be more interested in seeing what the full reaction is through the NVIDIA earnings gap because of the nature of the thin structure, right? 425.75 is the gap close. Just like the S&P, I suppose there could be an indication of a failed breakdown, so a look below and fail. If you can get a higher low that's clearly well defined over 434.65, you could start to trade it in the upward direction. But if we take a look at the hourly time frame chart actually here, you can start to see how this is a very sloppy move to the downside out of the QQQ NASDAQ. Like, do you really want to battle back up through that? It's possible. And again, I'm not saying that there's not a decent risk reward location here on a look below and fail. If you can go long here with a stop just below that, higher low and looking for that range rotation, of course the risk reward makes sense. Here's your risk, there is your reward to the upside over time, right? Retargeting the top end of the range. But is it going to be an easy trade, or is it going to be a difficult trade where you're maybe antsy about the trade, anxious about the trade, right? That's what this would sort of suggest to me. Look at all the back and forth in there, the two-sided trade that was taking place. I don't necessarily think it's going to be an easy thing to navigate through. And one of the risks that I would actually argue on the QQQ hourly here is that any lower high rejections underneath 438.50 are another daily lower high. And then that sets up, I mean, it's not even a man ray at that point. Let me know in the comments section what type of pattern that is. But here's your left shoulder. Here are your now 3 heads instead of 2. And there's your right shoulder, right? I would just, default back to, okay, we're just trying to analyze trend. You've got highs, lower highs, breakdown through the equal lows. You're now in a downtrend, right? So that's the main idea here out of QQQ. It's possible lower highs up against 438.50. It's equal low breakdowns underneath 433.75. It's lower highs in this range for the NVIDIA earnings gap to close. If the buyers are going to do something, again, maybe we participate on this type of move because the risk reward is so good, but understand that this is really, I would say, sloppy and risky activity to be trading back up through. If the buyers are truly going to build an upper hand here, just like the S&Ps, you've got to clear some key structure, and that would be here for me up around 441.50. If the buyers can do something that looks like this, I'd be thinking about what's the opportunity to test the all-time high. Let's finish it up with the anchored view apps on the intraday QQQ, and you'll notice that we're underneath all of them. There's much more of a risk and a threat, as we've just described, for the lower high on a retest up against that magic number at 438.50. So you're pretty clear on where my head's at in the NASDAQ side of the market. If we take a look at the internals, building out a stronger cumulative volume flow to the outside, certainly substantial on Thursday, neutral on Friday, right? We'll come back to that same sort of point here in the QQQ, which is we don't want to jump the gun, but it certainly seems as though we're neutral with definitely a bearish edge. Look at the volume outflows here. Look at the big cumulative build in the downward direction, 45-degree line, not some sort of liquidation break. Sustained bearish pressure throughout the day on the advanced decline line, getting underneath the 0 line. But what do we see on Friday, right? Really neutral, flat on the cumulative build, basically just hovering slightly above positive out of the advanced decline line. Again, I don't think that you want to jump the gun and just assume that we have to go here, but I would start to be thinking about how can we change our mental tone. It's been bullish along the way, right? Bullish, 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 bullish. That's sort of starting to come to a little bit of a halt, right? And I would be more open-minded to trading both sides of this market, possibly looking for some downside this week if we crack through the thin structure or reject for a lower high. Let's finish up the NASDAQ side of things with the market profile as we typically do. You can see the same takeaways as what we described over on the ES. Your value area area on Thursday underneath the value area from the Wednesday session. On the Friday session, certainly breakaway to the downside. Poor high here is worth noting. Lack of material excess at the lows. We do not have a poor high at the top of the move, so be mindful of that. We don't have that same back pocket situation, but I would make the same argument about the A-period single prints, the fact that there was no acceptance sort of above the value area low from the Wednesday session on Thursday. All the same takeaways. This is really turning into overhead supply. You have trapped buyers. This starts to break it down. I think that they're feeling that pressure, and it's very reasonable. Again, the odds of a breakdown have increased at the end of the week compared to where we were at the beginning of the week. And lastly, for the broad market on the weekly time frame chart, we have IWM Russell 2000 and the small caps. What do we see here in terms of candle structure? This is different. It is certainly not an inverted hammer. It's much more of a solid red-bodied bar with just a little bit of a lower wick, implying that the buyers tried to step up here and make a higher close, but it's still in the lower third of the entire weekly range. The only takeaway here is, as we segue into location, that's sort of bullish, is that this is potentially holding. As we know, on the daily chart, we'll see this as well. That's a little bit of a double bottom here and here. This is the neckline. Is this just a retest of that level? It's certainly possible, and one of the takeaways as to why this lower wick is slightly important here, especially in the face of a more solid red-bodied bar. If we think about location literally on the bar-to-bar count, lower high as well as a lower low, closing ever so slightly outside of the previous week's range in the downward direction. So are the bears building a little bit of an edge here on the weekly? I would say it's fair to say that, but it's not enough for the entirety of the weekly trend to reverse, right? We have lows, certainly a higher low, and an opportunity for a higher low over the retest of the neckline that we were just discussing. And as we know, the whole picture here in IWM is trying to align with a breakout of this as a multi-year balance range. Can we get over the highs? We sort of pulled back off of it once. We've broken out. Really want to see this area act as support. We know the key level is at 199 to about 200-ish, if you want to use a nice round number there. That is the major watch. As long as we can stay above that, I would not throw in the towel yet on the IWM, but there are some concerns emerging on the daily chart. We'll get there in just a second. Let's firstly take out the anchored view apps on the weekly, right? This big band of them is sitting underneath us, and over time, they will slowly creep in the upward direction. It would be better if these could be slightly higher, supporting the idea that if there is a failure of that neckline, we could still catch ourselves in that cluster of anchored view apps. We're not there yet, and that does have me slightly concerned about this as a possible failure point into the upcoming week's worth of trade. So keeping an open mind to if the weekly falls underneath 200, things start to become a little bit more concerning. If we bring out, let's take out the Fibonacci's actually from the low of this move up to the tippity top, just understanding that we're still over the 38.2. I mean, it wouldn't be clean. It would certainly be less than ideal, I'll put it that way. But bullish consolidation can technically happen here, and over time we'll continue to watch for that move in the upward direction. The largest threat on the weekly time frame chart is not just the failure of 200, it's the failure of 200 to prevent the higher low, but then more so bringing in a lower low underneath this set here at the 38.2, which is more closely aligned with 190. So as of right now, trying to remain optimistic, but like I said, on the daily chart, we'll start to see a couple of issues, and we'll talk about why it's really starting to emerge that way based on what we know about Fed policy and the fundamental data. If we take a look at the volume profile, this is a low volume void. The target overhead is this 225. It's the midpoint of this as a consolidation range. If we can hold this for a higher low and break back through it, great. That's a helpful piece of information for moving in the upward direction, but we're not there yet. Let's take a look from the all-time high to the low of the October pullback. Notice that this rejection is coming in right at the 61.8. If we were going to have higher odds of a 100% retracement, you really want to get over the 61.8. And even at that, we've talked about how 235 is a more appropriate target as this big flat top area of resistance, not wanting to cherry pick the all-time high. So we know our ups from downs on the weekly time frame chart. Let's drop it down to the daily and take a look at what's going on over here. Some of the larger concerns I have with this chart are really what's happening around this neckline here paired with the fundamental narrative, right? If we look at the IWM and start to see this breakdown, it's a reversal of the daily trend. We have highs, lows, and lower lows, right? So technically speaking, this is a very short-term daily downtrend looking for a weekly higher low at 199 and this area to hold. Daily 50 SMA is going to meet us there as well. Here is the double bottom. That's the neckline. Of course, you could refer to it as an ascending triangle, whatever you want to call it. 199 is a key must-hold level here. So how does this tie in from a fundamental point of view? We got two hot inflation reads this week, right? What would that mean for small caps? Obviously, if Jerome Powell is going to keep rates higher for longer, small caps would break down. They would not gap up like we sort of saw in a perverted way out of the S&P 500 on Tuesday, right? And you can see here out of small caps on Tuesday, there was no euphoric, oh, yay, hot inflation, right? It's not the case. So the small caps to me are a more accurate way of identifying and sort of looking at what might happen from a Fed policy point of view. And we know if there's no cut coming in June, that has to have some impact on the S&P 500 EPS expectations, because Q2 is where we're expecting to see that bump. So using the IWM as sort of a proxy or supporting evidence for understanding Fed policy, I think this makes a lot more sense that we want to dial back. Like, I wouldn't even call it 50-50 odds of a June cut. I would say that that would be a policy mistake to cut in June, and we probably want to look at something that's more like 60-40 odds, 60% representing a pause based on what small caps are doing here. The small caps can sort of see the risk of the hot inflation print and the labor market remaining robust, which of course speaks to the dual mandate of Jerome Powell in the first place. So I know we're getting a little bit fundamental here, but if we just look at the chart objectively from a technical point of view, let's get back to what we do best. Any lower highs underneath 204 that threaten 199 and consolidate down here, you've really got to see a strong daily reversal pattern off of this zone if your weekly high or low is going to hold. And remember that small caps are basically going to hold the key for your S&P, because we know that the NASDAQ remains weak. If the NASDAQ is weak and small caps are weak, then yeah, what is going to hold up the S&P? Certainly not the broadening nature of the market rally, right? So this to me is a big component of the analysis, especially as we get Jerome Powell and the Fed decision on Wednesday's session. So keeping a very open mind to 204 lower highs, threats at 199, all of this stuff is very top of mind for me as we head into this week. 199, if it breaks down, we've got something going on here at 196.50, but really after that, you're talking about 192.50, and as we just saw on the weekly, that's where we start to jeopardize this as a weekly higher low zone, right? So really thinking about how this plays out this week. The expected move is bearish still, with a lower high from here to here and a lower low from here to here. Let's take a look at the hourly time frame chart now that we've gotten off of our fundamental soapbox, and take a look at the trend. It's certainly down. You've got highs, lower highs, lower highs. There is the opportunity, and again, this is a very classic setup that you should always have in your toolbox, right? There's an opportunity for a counter trend move up and over this as a very nuanced hourly inverted head and shoulders. If we can break out up and over 202.75 on the Monday session, there's an opportunity for a scalp here long over the level into the retest of 204. You don't want to trade IWM, you don't trade small caps, that's fine. Just understand that the S&P should not be looking for aggressive shorts if you're getting this rotation out of small caps, again, early on in the week. I wouldn't be overly aggressive bullish here, and I would still certainly keep an open mind to highs, lower highs, and the opportunity for lower highs on the retest of this key level at 204. If we reject there, it's bears on parade. We're looking for that larger drawdown into 199, and we'll see what Jerome Powell has for an impact for us on the Wednesday session. Let's take a look at the market internals for the Russell side of things. You can see volume outflows on the Thursday session, a little bit more bearish activity on Tuesday, Wednesday, and even on Friday on a relative basis. So are the sellers, again, a little bit more concerned? Can they see more clearly what's happening from a fundamental perspective compared to the S&P and the NASDAQ? To me, the answer is absolutely. So that is that, and we'll move along to our market profile on the Russell. Big liquidation break off the open on the Thursday session. All of the value is lower, so trapped overhead supply absolutely. On the Monday, Tuesday session is sort of a little bit lower, but Wednesday session here, no acceptance whatsoever inside of that range. Immediate opening drive to the downside. All of the acceptance is lower. On Friday, we're just inside. So again, if the counter trend move is going to unfold and have this as a back pocket situation, that's fine, but it's really just a thin structure retracement through the A period single prints, right? So just as a different way to visualize that same exact trade. If you can take this out, if you can rotate through the singles, that's awesome. There's a trade to be had there, but it's not really indicative of a structural shift. As of right now, we've clearly got evidence of sellers making progress in the downward direction. Let's take it one step further and take a look behind the curtain at the weekly performance of our S&P sectors. Leading the pack here is energy, up 3.82%, which is slightly concerning because energy is an inflationary sector, but it's also a lightweight sector. So, you know, posture-wise, near all-time highs, not really what you want to see, which is another feather in the cap for the bears, saying, hey, the tech sector is not leading this pushback to the upside. be skeptical, right? If we look at the XLB, possibly the lightest weight sector in the S&P, up 1.15%, second in the list on the lineup here. XLF financials are a heavier weight risk on sector, but only up 0.79%, not even 100 basis points. If we take a look at the bottom of the barrel, it's the TLT, and that's not technically an S&P sector, I get it, but down 3.15%, meaning that interest rates across the board are moving in the upward direction. When we take a look at the TNX, there's a risk of a breakout there, and that would be bearish pressure for the market. Underneath is real estate, down 2.47%, obviously rate sensitive, and then it's the SMH, not technically an S&P sector, but semiconductors have led the rally in the S&P based on NVIDIA, based on AMD, based on all of these companies, right? Broadcom, SMCI, the whole 9 yards. That is a big tell, seeing this at the bottom end of the barrel. Underneath, it's the XLY, which is a heavier weight risk on sector. XLV, healthcare, second heaviest weighted sector, but D for defensive. XLK is red on the week, down 0.37%. So as this pullback is emerging, keep in mind that it's really just Friday that starts the pullback in the S&P. Before that, we were basically trading near all-time highs, right? So the posture is not great here. Another feather in the cap for our bears. If we take a look at the structural charts, we'll start to see some similar indications of balance breakdowns. Energy, fine. Inverted hammer, higher high, trading back up to this equal high, reasonable for a pullback, looking for a higher low to remain as an inflationary force. No issues there. If we take a look at the XLB, trading near all-time highs, we're not all the way there yet. Again, upward pressure is upward pressure, but it's a really lightweight sector for the market. It's not going to make or break us. If we take a look at the XLF, here we go. This is where things start to get a little bit dicey. Are we in an uptrend? The answer is absolutely. Is this a failure to hold over this breakout point, though? The answer is also absolutely. On Friday, we've closed right at the level. I would be more concerned with financials if we break down underneath 40.45 for a rotation to test the gap underneath. That spells S&P pullback, considering that it's the only heavier weight risk on sector towards the top of the lineup this week. So watching the XLF very closely at 40.45. If we consolidate above, fine. We'll hold on. We'll be all right. We'll be a little bit more neutral in my view. But if we break on down underneath, I don't think it spells anything good for the bulls in the S&P 500. Let's take a look at consumer staples in an uptrend, lightweight sector, D for defensive, a little bit of a pullback off of that high again, just like the XLF. Ideally, the higher low would have been above this level, but still okay from a trend point of view here. The reason that I'm not as thrilled about this compared to the XLF, or maybe we're just open-minded to calling this an uptrend and being like, it is what it is because it's a lightweight D for defensive sector. So if it continues and outperforms, it's just a classic, okay, risk off rotation takeaway compared to the XLF, which is a little bit more meaningful in my view. Next up, the XLI industrials. What do we see? Neutral consolidation, not really showing us much. Let's move along to the XLC. This is where we start to see some more emerging concerns. There you go. So look above and fail. We were wrong on the first go around for the bottom end of the range. Is the second time the charm, or will it have to be the third time is the charm? We will ultimately find out, but continued price acceptance underneath 80 certainly threatens the gap underneath us. Daily 50 estimate, that's downward pressure for the S&Ps, noting that communications are certainly more of a risk-on style sector. TLT drifting in the, not even drifting, but aggressively gapping down, of course, with the hot inflation reads. We'll get to that on the ratio chart in just a second. Real estate, rate sensitive, moving in the downward direction, lightweight sector, not going to be a make or break for the S&Ps. I would say consolidation in here is fine. Remember that it's really in the lightweight sectors, at least when you breach big, sort of pivot highs, pivot lows, that's when we're more concerned. So if we were to take this out, yeah, I would say that that's a larger issue, but as of right now, a little bit more neutral in this as a developing overall range. Next up, SMH, semis, what do we see? Weakness, right? So there you have it. There is your sort of head and shoulders underneath that neckline, and if you were to do something like that, look at the Friday session, rejecting in that upper wick, the neckline breakdown point. We have thin structure underneath to retrace. I'd be interested in the reaction at 212, and if that doesn't hold, it's all about the earnings gap up from NVIDIA. Under 206.50 closes down at 196.25. It was already a laggard. Keep in mind, it's pulling back from an all-time high. I mean, is this technically speaking a lower high? Yes, but like, is this the end of the world for the chart? Is the chart going to zero tomorrow? No, absolutely not. So still thinking about, again, what's the reaction at 212? Do we find buyers there? Or even if we do something that looks like this, keep in mind, you can get a correction and still maintain something like a monthly uptrend. Now, again, this is where it's very, very important to understand your time frame of execution. If you're a swing trader, great, you'll look for the monthly high or low. You're not going to short this to try to pick up pennies if you know that the upswing move is where you're going to collect dollars. If you're an intraday trader, then of course you want to participate in the downside activity. So those are the main levels that I would really pay attention to, and again, really understand your time frame of execution. If you're a longer duration trader, keep in mind that this is okay. This is not the end of the world out of semiconductors. So really take that to heart this week as the market potentially gets a little bit, I'm not trying to spread fear, uncertainty, doubt, right? FUD as they call it, but market could get a little bit shaky here. I use that word intentionally in the intro, right? You can start to see that the XLY here, like as we continue to look at things that are shaky, here's a balance range, there's a breakdown. Look at the upper wick rejecting this as overhead supply. XLY is a heavier weight risk on sector. If this continues, if this is a rejection, you've already got a daily lower high, you've got some sort of lower low being brought in, right? If this continues, it spells trouble for the S&P, right? Next up, we've got the XLV healthcare sector. Same concept, right? Here was a balance range, tried to get up and out of it, back down towards the lows. Another lower high and a breakdown through the lows of the range. Although it's D for defensive, remember, it's the second heaviest weighted sector by market cap. Of course, that spells trouble for your S&P XLK. What do we see over here? Gapping down on the Friday session, not even closing the gap all the way overhead, so a lack of stronger buyers. It's all about the NVIDIA earnings gap, right? Underneath that 203.90, look for that to close, and that's down here at 199.25. Maybe something at the daily 50 SMA, but this is starting to look like a threat as a whole lot of overhead supply. The NASDAQ is not as bad. If I just quickly flip back to the QQQ, right, you've technically got this as overhead supply, but look at how close that is in proximity, whereas if I go over to the XLK, just look at the different, like this gap down is more meaningful out of the XLK as a sector. This is clearly disjointed, whereas there's a little bit, not much, but a little bit more overlap in the QQQ, right? So keeping that as a sort of back pocket understanding in the S&Ps. Next up, we've got the XLU. It's down on the week, but it's really just consolidating up and over that neckline still. If it starts to outperform next week, that would be a sort of red flag to understand the risk off rotation coming into force. So watching utilities next week, if it breaks out up and over 64, there's your red flag for a deeper pullback in the S&Ps, right? Next up, oops, we already covered the SPY already in depth, so let's move along to the sector ratio grid. If you're not familiar with the screen, check out the video tutorial in the top right-hand corner. XLK drifting in the downward direction. Any surprises? Not really based on the structural charts, but from a risk-on versus risk-off perspective, small red flag. Financials, as we know, could be the saving grace. As of right now, we're still a little bit skeptical with that close near the 40.45. If it holds, great. Maybe this drifts in the upward direction. Maybe it keeps us neutral to slightly risk-on, but it's not enough. Look at the XLY drifting firmly now in the downward direction. We've obviously got new lower lows. We're underneath the descending 50 SMA. XLV is not yet a threat. The 50 SMA is still more so flat over here. I would say that industrials are technically 8% of the S&P 500, not as risk on as communications, which are a little bit more flat over here after a more meaningful pullback. If we look at the risk off sectors, we are not yet risk off. We are not yet risk off. These are underneath still downward sloping 50 SMAs, but keeping a very close eye on them. Energy as an inflationary pressure is becoming a small concern as it breaks out here. Let's take a look at some specialized ratios and really start to understand with some more nuance what's happening. If you break down through these equal lows on the XLK, SHY, more concerning for downside. Why are people flight to safetying, if you will, into short duration? Basically the equivalent of cash. SHY is the equivalent of cash for all intents and purposes. Next up, XLK over the XLU, so tech versus utilities. There's sort of your breakdown point. If we snap it this week, you know the drill. So maybe set some alerts here. Do whatever you need to do to remember to look at that ratio. If you break down, more of a risk-off rotation. Here we go. Apples to apples, XLY, XLP, discretionary versus staples. It just cannot seem to it can't get out of its own way. This is technically speaking a broadening wedge, something that looks like this. And that can continue for a while. So if it really makes the move down to the bottom, risk off. If it just remains within, I mean, you've got to acknowledge that you've got higher low, but also lower high. So not really constructive in either potential direction for a firm takeaway, at least in the coming weeks worth of trade. I would say here's your concrete takeaway, right? Just to sort of make this something actionable. If you make a new lower low, more of a risk-off look for the market this week. All right, any consolidation in here, a bit more neutral. Next up, we've got ourselves the SMHXLV, so semiconductors and healthcare. Breaking down underneath this as a double top neckline leaves the door open for a pullback, but just like we talked about on the SMH chart itself, it's not the end of the world. Certainly an opportunity for a higher low here. Lows, higher lows, higher lows, higher lows over the breakout point. So keep in mind that you could see a pullback here, which would look like risk off in the market, but I wouldn't throw in the towel on this one specifically yet. Overall, I think the takeaway looking at these sectors is that we have neutral, but not all the way to risk off yet. We're definitely not in a risk off environment just yet. If we take a look at the dollar, a little bit of a rebound into the end of this week, which makes sense. Tightening financial conditions, putting downward pressure on the S&P over here. Moving along to gold, let's have a look at the GCs. A little bit of a mild consolidation, so the dollar moving a little bit more freeform, if you will, as gold is consolidating after this huge breakout. Remember that the gold breakout here, along with bonds sort of falling off of a cliff, to me, you've got this really interesting dynamic of like push and pull between truly flight to safety risk off assets. Gold could be seen as one, right? I understand it's technically just a currency, right? But being seen as possibly a store of value through inflation, I don't know if market participants are necessarily regarding it as that during this breakout, but it at least raises the question. We have to be slightly concerned about that. What is silver doing? We said it was looking pretty good, and yes, we did get the breakout all set based on the Wednesday comment there. Let's move along and take a look at interest rates, the TNX, because this is where I really think we have to focus this week, especially with Jerome Powell on the mic on Wednesday. Your 4.3 on the 10-year looks like it could possibly break out. If we were thinking about this chart purely from a technical point of view, you had highs, lower highs, lower highs. This was sort of an equal high, right? And breaking down from this as a balance range here would have preferred to see a lower high underneath 4.2. Obviously on Thursday, Friday, that did not happen. So with this sort of failure to produce trend continuation, if we move through the top end of the range, that is going to spell trouble in my view for the QQQ as well as your SMH, obviously, as a byproduct. So watching interest rates very closely early on in this week before Jerome Powell even gets on the mic on Wednesday to see if we break out over 4.3. If we do, I think it spells trouble for this market. Let's finish up the interest rate talk, at least from a technical view, with the inverted ZT moving in the upward direction. I think that the market is finally starting to see that, yes, the June timeframe should more appropriately be priced at 60-40 odds, but let's see if they're there yet on the Fed tracker tool. So nobody should be surprised by the fact that we're not expecting a policy shift on the Wednesday update from Powell, but what I'm very interested in seeing is how the probabilities shift for the June timeframe meeting as the FOMC press conference is taking place. In my view, a more appropriate spread of the odds here would be 60-40 for a continued pause in the June timeframe, not some sort of cut, unless there's going to be some sort of like Fed intervention because, oh my goodness, credit spreads are expanding, there's a credit event, oh my goodness. Unless the Fed needs to intervene, I'm not really seeing why they would cut rates in June. As we know, inflation is not continuing to subside, and instead it's finding a floor at 3%. The labor market continues to be robust, and expect Jerome Powell to reference both of those things in his conversation on Wednesday. If we take a look as a recap of what happened last week, here is your hot inflation print, and here is your robust labor market coming in at 209,000 instead of the 218,000 expectation for initial jobless claims, right? As we know, if we're nowhere near 250,000 as a threshold, there's no reason to be concerned about massive unemployment, massive layoffs, even if you hear anecdotal stories about tech companies laying off XYZ% of the workforce. Another interesting one here is what happened with the PPI non-core. I mean, we got a 0.6 versus the 0.3 expectation doubling. That's a huge miss in the upward direction. If we take a look at the inflation expectations on the Friday morning session, 3% unchanged from a 3% prior. And just remember that expectations have a direct impact on the realized inflation that we see. So again, when we talk about a floor at 3%, it's not just the data, it's what people are actually feeling and their expectation for what we have moving forward. Let's dive into some of these things with a little bit more nuance. Actually, we can go back one last time here. Just want to illustrate what we have this week, right? Obviously, Fed comes out on Wednesday, 2 o'clock, and the presser from Jerome Powell at 2:30. As we move into the end of this week, we'll see what happens with the PMIs on the Thursday morning session. Then Powell has, looks like a little bit of a follow-up speech on the Friday session, so be aware of that. As we break it back down, though, through the PPI, we already talked about CPI. You can go back and watch Wednesday's update video if you're interested in that. The supercore was very hot, right? But the PPI, if we take a look at the blue box in particular right here, cyan, if you're a little bit more nuanced in your color palette, it actually decreased, and this represents services. Services, I thought, was the sticky side of inflation, and goods, that's where the battle was won, right? Well, all of this represents goods inflation on the producer side of things, and that's re-accelerating. So if we have sticky services inflation and re-accelerating goods inflation, that really doesn't speak well for what we have in the next print for CPI. If we take a look at retail sales, which came out on the Thursday morning session as well, remember back to what the largest contributor was outside of like housing services for the CPI, right? It was transportation services. A lot of it was insurance, but what do we see here? Where were the retail sales? Blue represents motor vehicle and parts dealers. So will we expect, auto services to come down in the next print? Based on retail sales, there's obviously demand for it. I'm not convinced. I am not convinced based on what we see in this particular report. Here is your employment situation finding an equilibrium out of continuing claims. So again, expect a reference to a robust labor market from Jerome Powell there. And the 4-week moving average of initial claims is moving in the downward direction. Once again, speaks to a robust labor market. People are getting jobs and sort of holding jobs based on this moving in the downward direction. These folks, it looks like they could use a little bit of help here. But why does this all matter? Let's take a look at like where the rubber hits the road. And this is going to be a really sort of interesting exercise during this week's episode. So bear with me as we do this. So decline in estimated earnings growth rate for Q1 this week. You can see that we fell to a 3.3 from a 3.4. That's not too bad, Matt. What are you talking about, dude? That's 10 basis points. Well, take a look at what's happening over here. 3.3 is what we have today versus a 5.7 to start the quarter. Why does this matter? Well, bear with me as I scroll down to the chart we're looking for. We're going to walk you through why this is such a big deal, and the Fed policy decision around the June cut is very, very influential to the S&P price, right? So if you take a look at what's happening here, basically means that the growth rate of this number is not really what was expected come the December anticipation, right, earlier on in the year. So what we can do is a very simple exercise and just reduce some of the expectations here, because again, it's my belief that it's a mistake for the Fed to cut rates in June. So if this number is not going to be as high, what does that ultimately do for the pricing of the S&P? And all we need to do is really calculate 4 of these for 4 quarters in annualized EPS. Then we'll multiply it by the current PE and see what happens while reducing this to, let's say, 57. All right, so let's do this together. 55, 56, 55, 56 plus 55.02 plus, we'll go 57 on this one, and then we'll go plus, this one up here is 63. Oops, we want, let's go 3, and then minus 3, and then plus 63.51. There we have it, for a number of 231.099 cents on the annualized EPS for the S&P 500. Great, that's a useful number, Matt, but how do we actually figure that out for the S&P price? Here we go. This is the PE ratio. Let's round up here. Let's give the buyers the benefit of the doubt and call that 21. All right, let's go 21 on that particular number. We'll multiply by 21, and what does that give us? 48.52. What is the S&P currently trading at? We're very close to 5,200, as we all know, right? So if we need to reprice to 48.52, that spells trouble. And again, the idea here is not to be precise. We're not trying to accurately forecast the exact number for how we'll close the year and exactly what's going to happen here. We're talking about a directional vector based on the fundamental analysis, right? Certainly, the market is ahead of itself in terms of pricing if we do not get the expected cut in the June timeframe. So hopefully that was interesting for you on today's episode. Let's take a look at the earnings calendar for the upcoming week's worth of trade. There's really nothing on here that catches my attention other than not only did they move Embraer, but it looks like they're going to have Micron in terms of the semi space, and then you get some interesting Nike, Lululemon, I always get that one wrong, so there we go, watching out for that. And General Mills will be insightful as well from a consumer staples spending perspective. The big takeaways here are probably Micron and these guys Nike for consumer spending, and oftentimes FedEx actually. Let's throw them in the honorable mentions as well. They have some interesting insights into global logistics. They were pretty good on the call early in 2022 about the larger turn to the downside. So watching out for those honorable mentions, but other than that, let's get back to the technicals and talk about risk appetite. So the TLT ratio to the S&P is not currently suggesting a flight to safety style trade, so risk appetite for equities appears to be strong based on this view, but if we actually take a look at bonds in relationship to themselves, you'll start to notice that they're moving in the upward direction here on the heels of these hot inflation reads, suggesting that the shorter end of the curve is still the preference. But something that I want to show you is that the 10 and 2 inversion, let's go to the 10-3, so 10-year, 3-month inversion here. Let's drop this to a weekly time frame chart, is drifting in the upward direction, suggesting that the long end of the curve is also moving in the upward direction. We could take a look at the TYX here as the 30-year. You can see that this is moving higher. What this would suggest is that the neutral rate of the market is being priced in higher in response to the market figuring out that inflation is not continuing to subside to the degree that the Fed would like. Therefore, the longer end of the curve moves higher, and that makes everything more expensive in terms of financing costs, I should say, and will have more of an impact on your IWM, your commercial real estate markets, your even single-family homes, right? So this, to me, is sort of, it's a counterpoint to the TLT ratio to the S&P, which looks like at first glance, oh my goodness, everything's fine. But when the longer end of the curve is aggressively moving in the way that it is, even as the short end is also moving, I think it leaves a little bit up to interpretation. Again, I don't want to be like totally FUD, oh my goodness, the market's going to zero. It's just something to start paying attention to as we're at this crux where inflation seems to have found a bit of a floor, right? It's a discussion about this, really. If we look at credit spreads, the longer end, the longer end here, the IFLQD, moving lower, the shorter end, SHY-HYG, small uptick, nothing major. I wouldn't be like, oh my goodness, credit events around the corner. For the most part, they remain stable and depressed compared to where we were not so long ago, even on the heels of the New York Community Bank, right? Sort of, seeing a little bit of volatility. Nothing has really come out of that looks like a major concern. Just a reminder, this is SVB back here. Let's take a look at HYG in isolation. A little bit of a negative divergence here with a bigger lower low compared to the equal low, maybe slightly higher low that S&P equities got. But as we know, the larger breakdown is underneath 76.6 inside of the HYG. If this takes place and the market's still sideways, huge red flag, major divergence, looking for shorts, looking for these things to get back in sync. We just haven't done it yet in the HYG. So trying to keep an open mind, but subtle and smaller divergence worth at least paying attention to. Let's move along and take a look at Bitcoin. Everybody was sort of flustered about the pullback in Bitcoin, but my goodness, I mean, look at the breakout. Give me no pun intended, give me a break, honestly. Like, this is okay. It's okay that Bitcoin pulls back to consolidate and digest some of the gains that we've seen over here. So if we think about risk appetite in Bitcoin, still remains incredibly strong based on the chart that I see in front of us. Let's move along and have a look at breadth. Oof. Ouch, not looking good. So flipping back over into bear mode, I mean, we're not under the zero mark, but if you want to talk about meaningful progress in the upward direction, this is certainly not what we want to see. Again, it's not enough to throw in the towel. I wouldn't go short the S&Ps. I wouldn't be like, oh my goodness, we're going to zero. But if we start to crack the zero line in new highs versus lows, yeah, another red flag to at least discuss here for our S&P 500. So watching market breadth, something that would have been way more constructive is the market's going sideways up here and breadth just remains stable or sideways. That's obviously not the case. So here you go. I'm raising it to your attention as a small red flag. Let's move along and take a look at the SPX A200R unchanged on the week. Nothing to really talk about on that front. SPX A50R, deeper pullback over here, but still well above the neckline of the inverted head and shoulders. I would not look at this chart and say, oh my goodness, markets are going to zero. Reasonable give back after a strong move off of the 50% mark. What do we see out of the RSP, equal weight S&P 500? A little bit more meaningful of a pullback taking place. You'll notice that the breakdown on the Thursday session did take out these lows, and we do have, in theory, thinner structure to rotate through down towards that 158. Not calling for this type of move, but if the RSP starts to break down there, breadth-wise, that sort of aligns with the new highs versus lows, suggesting to be a little bit more cautious of the S&P, especially if you're not going to have the one stock to rule them all, NVIDIA, continuing to prop up the boat, right? Next up, we've got the QQQE, which is the equal weight NASDAQ, and these are pretty much in lockstep. There you have your sort of equal lows. There's your equal lows, breakdown. Of course, they're moving much more in sync. Let's take a look at the Dow Industrials versus transports. Range compression still out of transport, still divergent, still disagreeing with what we see out of industrials, but not enough to just go out and short the S&P. So back pocket idea for all the Dow traders. Next up is the VIX, and the VIX, I thought, after the PPI, after the retail sales, was going to sort of contract a little bit here, but because of the way that inflation came in hot, they're still holding that trend line. You can see that we are rejecting the 15 mark, but if we take a look behind the curtain at the VVIX, and this might even just be in anticipation of the Fed on Wednesday, right? But look at the VVIX creeping in the upward direction. So volatility moving higher as a catalyst certainly seems as though the market's on edge. So once again, as I'm talking about all of these maybe slightly more bearish data points than what we're used to recently, I think they're actually founded in concrete evidence, logical data points, as we always mention in the intro. And this is not just like, oh my God, I have this feeling that the market's going to zero, right? Let's take a look at the futures of volatility, and you can see we are in contango still. I am interested to see what happens on the actual contract flip during next week's session. You can see the 9 versus 30-day VIX is a little bit in backwardation here, but back towards the zero line to close out the week. So volatility, again, it seems like it's a little bit uneasy out there, but not enough yet to say, oh my goodness, backwardation, it's going to be difficult to get volume inflows to the market. We're not at that point. If you've made it to this point in the video, I'm sure you're enjoying the analysis. All I'm going to say is 100K by May. And with that, we'll jump right into Apple to kick off the core list of companies. Obviously, we have ourselves the breakdown of the big daily inflection point at 180.25. But with this little balance area brewing after forming a lower low, I think it's very reasonable that on the daily or even weekly time frame charts, a lower high could be found after a counter trend move retests 180.25 from the bottom side up. So how might that actually happen on the hourly time frame chart? Take a look at all the nonsense that really happened into the end of last week. This certainly offered the squeeze that we talked about as a trade idea on the Wednesday midweek market update. But look at Friday. Upper wick shows a clear rejection of this as overhead supply, yet into the afternoon, we break back up into that range. That's kind of a little bit of a head scratcher for me. So to treat this with its simplest form, it's just patience. break, retest, higher low over 173.75, trades for the gap close, and then we're looking at that 180.25 daily inflection point that we were just referencing. If it's going to be a short for continued downside, you might be able to get involved underneath the low of the Friday session because you're using all of this as overhead supply, but you're trading directly into these prior lows. I think that it's totally, here's a range. If you do something that looks like this, great, keep it simple, stupid, right? 173.75, or breakdowns here get you to that 167. Keep it simple, stupid, lower highs underneath 169.75. With that, we'll move along directly into Microsoft. I want to go out to a daily time frame chart to illustrate the balance range trying to resolve in the upward direction with the higher high from here to here. A little bit deeper of a pullback than what the buyers would have liked to see. Ideally, this would have gotten like a day 2 continuation, then offered a pullback over the top of the range, but let's deal with the chart in front of us, right? Dealing with this, I would say that the close being over this level right here at 415.75 is somewhat insightful, right? Let's actually drop it down to the hourly now that we understand that context. So if the bears were going to build an edge, it probably would have come from a closure underneath this level, then threatening early on in the week something underneath 412.50 for a thin structure retracement. Simply didn't take place. So as we walk forward, this is a patience play. This is the long, trading back up towards that 426.75, and this is the short, not this, but this right here, the lower high underneath 412.50. So very simple roadmap out of Microsoft here, 419.25 and 412.50. If we're consolidating over 415.75, I would argue that the buyers have the upper hand based on coming from the highest high in the trend cycle. This would then be your next higher low. Let's move along to Google. Nice little recovery effort happening over in Google after the AI nonsense, if you will. Here's a breakdown. Here's a 100% retracement. And now look at the higher low offering over 140. If Google can consolidate up here, that's a pretty bullish look. Let's take a look at the daily chart just to understand some context, right? Think about the Wednesday inverted hammer upper wick rejecting 140, which has plenty of price history, right? Plenty of price history at 140. If there was going to be a clean lower high, that's where it should have been. Reject that level, keep all of this as overhead supply, and instead, on Thursday and Friday, you can see that we actually accepted above. So as long as we're over 140, I would be open-minded to more than a possible counter trend. Perhaps this is the beginning of a stronger uptrend developing. We're not there yet, but keeping an open mind to it. I think it might be difficult for some folks considering the sort of attachments to the Gemini model, what went wrong with it, Google as a company. The price action itself is saying quite clearly, if we're over 140, I think you at least have to be more neutral and not as bearish as we once were. Next up, we've got Amazon. What's happening with Nancy? Be my guest if you want to get chopped up in the range, just like Apple, I suppose. Keep it simple. Something that looks like this, something that looks like this into the gap as a possible trade. Here it is on the hourly. Just to be a little bit more clear, the upside may be more actionable than the downside. The reason I would say something like that is because if this turns into a very nuanced double bottom, right, there's your neckline, higher lows above, you've got tradable outcomes to the opening print to the high of day and then back up towards this 179.50 area. That's a possible long entry here. You'll notice that, sure, it's choppy in the past, but this thin structure breakdown on Friday can be retraced. And it's very similar to the idea out of Apple where you get an opening drive, consolidation into the afternoon, those shorts will squeeze out if you get acceptance over that neckline. So 175.35 could be your trigger for higher, but the better trade is really being patient for this on the higher time frames. If you're a short, notice that you're not getting as much reward on the downside. So a little bit more skeptical of the downside out of Amazon for that reason. And as we talked about on the daily, it's all about the gap close. 172.35 closes at 170.25. Next up, we've got NVIDIA, the one stock to rule them all. Here it is on the hourly time frame chart. Just want to give you some broad levels, and then we'll talk about the IV on the daily chart in a second. So if you're over 922, great. I think that's where the better long unfolds. Maybe there's a scalp in here, but this is still very much so a balance range to me. If you break down from this balance range, I don't think it's a short in these places. I'm not seeing it. Maybe it is, and if you've got the sort of risk tolerance for that, that's fine. But I would tend to think that like this is something that can unfold, but I'd be highly attentive to what happens at 802.85. This as the previous range that then broke out for the last major leg higher in the move. Can we get some sort of weekly higher low for 802.85? Like that's the big question I have next for NVIDIA. We know that anybody who's tried to short this thing aggressively hasn't worked out well. So until we're actually in a firm downtrend, probably on the weekly chart, I don't know that I would try to jump the gun and step in front of the moving freight train. So back to the daily chart, just to give you an idea of what's still happening with the IV rank, it's extremely elevated. So it's higher than what we had pre-earnings, right? So I don't know that the juice is worth the squeeze out of something like NVIDIA. A lot of folks have been asking about this study. You can find this online at a number of other people's websites, but I'll list it for Sunday morning, right? I can't promise you Saturday night, but by Sunday morning, this will be free at tradebrigade.co/trading-scripts. You'll be able to download the IV rank, okay? So if you're interested, look out for that on Sunday morning. Next up, let's actually go to AMD. Let's give an honorable mention to AMD as NVIDIA remains, I wouldn't call it untradeable, but less than desirable from my point of view. If we look at AMD, I mean, you're definitely getting some volatility here, but it's not nearly as elevated as NVIDIA itself. The options pricing is a little bit more manageable. So this is kind of the interesting look, right? Can we hold prior rejections as newfound support? And that would almost, not exactly, but almost be the equivalent of that 802 retest level we just discussed in NVIDIA. If we take a look at the AMD hourly chart, right, what's the threat, or the risk, I should say? It's this level right here. So potential continuation that rejects off of it, I would be looking for the higher low that then equal high reattempts this forming some sort of inverted head and shoulders. And then after we have a clear higher low coming from this head, that's where I would look for the breakback in the upward direction. If you're like, Matt, nope, you're wrong. You're all wrong, dude. You're going to get this one wrong. That's fine. If you want to go short up against this level at 197.40 and trade this thing in the downward direction, if you think that it's actually on the daily chart going to look like this, H pattern, right, into the equal low, then a breakdown, fine, be my guest. As long as you have tight risk reward, I would be aiming to travel, or I'd be aiming to negotiate a trade. There we go. What's going on with the vocab? I'd be aiming to execute a trade near either of these trade locations, right? 197.40 really captures my attention out of AMD. Next up, we'll go on over to Mark Zuckerberg's Fantasyland. What's going on in the metaverse? Big retest of this level right here. You are getting a little bit of that H phenomenon already. So high, lower, high. If this breaks down as a head and shoulders, I don't know that I would say kiss it goodbye, but it's certainly a threat to the bottom end of the range. And we know that the XLC as an index or a sector ETF really looks weak already. Let's take a look at the hourly chart here to see what we can learn. Breaking down from this as overhead supply. What's the name of the game? Any lower highs underneath 490, keep the downward pressure on. Then it's all about the gap close underneath here. So 476.10 closes at 468.75, 466 as a more important structural level. That's what the bears want to see. If you're going to be a buyer out of this name, I would say that acceptance here is a good first step, but this feels a little bit more comforting with the higher low over the previous top of this overhead supply. Next up, we've got Tesla, the one stock to drown them all. Moving in the downward direction big time, breaking down underneath the head of the inverted head and shoulders from over here, breaking down from this as a balance range. It is bears on parade out of Tesla. So to the downside, interestingly enough, we do have this unfilled gap. So I would want you to be aware of that. Under 152 closes at 146.15. If we break down underneath 159, that's how that's achieved. If we take a look at the daily chart a little bit closer here, this is a bearish 3-bar play, right? Momentum to the downside, a little bit of a pause. It might be a little bit deceiving, looking like a hammer candle. My goodness, the market's got to rebound off of this low. It's technically a bearish 3-bar play. Any consolidation here that breaks down through these equal lows, off to the races 159, 152, 146.15 on the downside. If we take a look at the hourly time frame side of things, again, as long as the consolidation is underneath, looking for downside outcomes. If we pop it, if this turns into an hourly double bottom, great. We will go long on the intraday higher low or break under reasonable circumstances over 165.75 for a rotation in the upward direction, but we are not overstaying our welcome. Certainly an opportunity for a daily or hourly lower high up against 173.15. Last but certainly not least is Netflix. What do we see out of Netflix? A little bit disappointed, honestly, on the Friday session. With the upgrade there, mentioning some AI stuff, breaking out of what appeared to be an ascending triangle here, completely failing back down into the range. So with that, I wouldn't throw in the towel on it yet. You'll notice that we are getting consolidation here. It's still an opportunity for some sequence of higher lows that look like this. There's your flat top. But over 616, you need the higher lows. You need the price acceptance over 616. And when and if that happens, probably not probably, but actually very interested now in what this level has to offer. Why are we not getting a click? There we go, Thinkorswim. Thank you. Let's edit this up to be 23, round numbers only up here in the penthouse. There we go. Clearance of that. So step number 1, consolidation. Clearance of that. The door is wide open to 644.75. So lots of upside to trade for out of Netflix under those circumstances. Be my guest if you want to get chopped up in the range, as we've been saying with a lot of these names. If it starts to swing it to the downside underneath 605, downward pressure for the broad market, and it's not looking so hot under 605 into 590.25. That's it for the core list. Let's jump into a couple of ideas. First idea is on ticker DG, Dollar General, looking at a bearish engulfer on Thursday, inside bar on the Friday session, breaking down through these lows at 148.75, opens the door for the retest of these equal highs at 145. If we take a look at the hourly time frame chart, really want to point out the fact that in the second hourly bar of Thursday, got a decent sized upper wick there, and on Friday, we didn't even retest the top of that upper wick. So bears are making progress in the upward direction. Notice also, very nuanced here, if you extrapolate out the Wednesday low of day, that's exactly where the high of that upper wick is on the second hourly bar from the Thursday session, this one right here. So if we can get the equal low reattempt looking left, we've got thin structure to retrace, and once again the target is the flat top breakout point at 145. Looking for a little bit of a short scalp here out of DG, Dollar General. Next up is HD, Home Depot. What do we see out of Home Depot? Possibility for a lower high double top here. If we can break down underneath this neckline 370.50, trading back down to close this gap at 364.85. When and if we get there, if the 50 SMA is offering confluence, please don't overstay your welcome out of Home Depot. Certainly looks like we are in a glaring weekly and daily uptrend, maybe not so much with the lower high being offered here, but for the most part, weekly uptrend absolutely, and an opportunity for a retest higher low over that gap fill area at 364.85. If we take a look at the hourly chart intraday, notice that Friday was an inside bar to the Thursday range. So to me, looking for that downside to play out underneath 370.50. Looking left, you can see also flat bottoms over here. Clear this, the door is open, gap close, prior top, right? So 364.85. Next up, after Home Depot, we've got DELL. DELL is the ticker on that one. Very classic. Ancient tech, though. Ancient tech. And you can see that we are drifting from the earnings gap up through the earnings gap. And this is certainly a threat to the downside. If you take a look at what the daily chart is offering, it's a bearish 3-bar play in the downward direction. So indecisive doji on Friday after bearish momentum, it just looks like a bear flag, right? If we can continue that, looking for the gap to continue to close under 105.15, trades down towards 95. You'll notice that a majority of these ideas are on the short side. It would be ideal if the broad market itself is cooperating and also moving to the downside if these separate ideas from the core list are going to come into play. That's DELL. And next up, we have PYPL. If we could not get a bracket, PYPL, there we go. And this, of course, is also a short idea. So all short through the additional 4 inside inverted hammer on Friday, sort of rejecting in these upper wicks the highs for the continuation of the breakout. Not the end of the world here. If we can break underneath these lows, just looking for a retest higher low over this as a possible double bottom neckline at 60.25. So what's the idea? Let's go on down to the hourly. All of this turns into overhead supply. If we break down under 62.25, intraday lower highs here, 5-minute chart, 15-minute chart, whatever floats your fancy, looking for a retracement through the thin structure and then changing tone when and if we can retest 60.25. That's what I've got for you today in the episode of the Weekly Watchlist. If you enjoyed the video or learned anything new, let me know down below in the comments section or by leaving the video a very simple thumbs up. Remember, 100K by May. We'll see if we can do it. We will be live all of next week in the pre-market prep, kicking off at 8:15 Eastern Time up in the penthouse suites. So come join us, come hang out. And with that said, I wish you a green trading week.